Hello, everybody. My name's Tim Reed, real estate investor and realtor in the Calgary area. And today I want to talk about one of the secret weapons that a lot of our investors are using that almost 98% of realtors have never even heard about. And it's called agreement for sale. This is one of the best ways to acquire properties, leveraging existing financing in place, not having to put a full down payment into the property to acquire it. So you have a period of time to renovate that property, stabilize that property, flip it if it's a house, or stabilize income and be able to get new financing if it's commercial, which works really well for larger multifamily projects, which we do a lot of that here in the Calgary area. So I'm looking forward to walking you through how this process works step by step. And if you want more details about how to execute this, I've done this many times myself in the past, both bought properties this way, sold properties this way, and helped multiple clients be very successful with this strategy, sellers as well as purchasers. So please get hold of us at the number below if you want to know more about Graham for Sale. So the first step in the process for the Graham for Sale is acknowledging that not every seller this process is going to work for. So a Graham for Sale is a really good fit for certain scenarios, then it's not the right fit for other scenarios. So the first thing you need to determine when you're talking to the seller's agent or if you're talking to the seller directly, you want to ask them what amount of cash they need in their pocket today is going to make them happy. So there's a number of benefits for agreement for sale or other vendor financing VTB structures is the tax savings. So that's one of the number one reasons that they could get some cash today and get the rest of the equity out of their property in the future on an agreement for sale because that will allow them to save money on taxes. And in some cases, with a free and clear property, that could be really significant. They could be saving tens of thousands of dollars, maybe hundreds of thousands of dollars on their tax bill by selling the property this way. So the first question you need to understand is what's the leverage on the property? Is it paid off? Is there a small mortgage, maybe $400,000 when the property is worth $1 million? Then we've got some room to maneuver. We've got some room to work. And of course, when you're talking to real estate agents, we need to know how we're going to get paid. The realtor's commission has to be protected, and the other agents got to be comfortable working with you and explaining the strategy to their seller that they're going to get paid. Of course, we all have to eat. We have to put food on the table. You want to make sure that you're understanding that's the goal of the real estate agent is do a great job for their seller, but they also have got to get paid too. So knowing where the financing currently stands is looking at the price that you can pay for that property and what deposit the seller might need today to be able to pay off bills, maybe pay a second mortgage, maybe buy another property, depending on what's going on in their portfolio and where they're at in their investment journey for that particular seller. So that's the first thing you need to know is what the underlying financing is in that property to see if this strategy as agreement for sale could be a good fit for that particular seller. You need to find out what's going to work for them and make a win for the seller so it can be a win for you or for your client. Step number two on agreement for sale is you need to understand what your exit strategy is going to be. So an agreement for sale, and I'll go through all the parts here next. An agreement for sale is really important and a really great leverage tool, but it's always a means to an end. So you buy an agreement for sale with an exit strategy to pay off the balance of the equity to the seller. And this is why you need to understand the seller's goals, number one. Number two, you have to show the seller the process and often the seller's agent, and I can help you with that. If you need help with that, please reach out to us at the number below and we'll walk you through it and help you negotiate these deals with sellers and with private sellers alike. Is that you need to show the seller there's going to be the exit. So that's going to be refinance, that might be selling the property, that might be, bringing in possibly private money to close them out. You have to show them what your plan is to be able to exit the property. You're going to raise rents, you're going to improve the property, or maybe just going to renovate the property and sell it. Those exit strategies are all valid, and it's always good to have a plan A and a plan B so you can show a reliable path to closing out the deal at the end of the term in the agreement for sale. So here are the components of the agreement for sale. First of all, you're going to have a deposit. And you're going to give it to the seller to allow you to do the agreement for sale, and you're going to agree to a price today, which you're going to pay in the future. The best example I can use to compare this to something people might be more familiar with is a pre-sale condo that you buy today, you put a deposit on now, and when the building is built in a year's time or 2 years in the future, you have to close the deal, right? You buy the property for $100,000 today, and it's still $100,000 when it's built. and it probably might have gone up in value, but that's what you owe the builder. So that's what you're going to owe the agreement for sale vendor in this case is the price you agreed today. Say it's $1 million for a fourplex here in Calgary, for example, and you have a 1 year term. The 1 year term is very common. It could be 18 months, it could be 5 years, it could be 10 years, or it could be 100 years for sake of example. However long you can negotiate with the seller. But I will be very frank with everybody here. I'm always no fluff, no fairy tales. 5 year term, 10 year terms for this type of financing is a really long time, especially if someone's owned the property for 25 years. They're looking to cash out, get their equity, save that tax, but they don't want to hang in there for 5 years. So that may happen in certain areas that's tough to sell properties where there's not a lot of sales or the property might be a little bit distressed and it's going to take a long time to stabilize that property. Then you might see longer terms in those circumstances. But if the property needs a bit of renovations, needs rents raised, for example, that project, which we talked about at the beginning of this section, is for your exit strategy, you have to show them how long it's going to take. So to be able to get longer terms, you need to demonstrate a very long project life cycle to sort of rationalize and make sense of that longer term. Because let's face it, everyone doesn't want to wait forever to get their equity out. They have plans and things that they want to spend that money on. So that's section number three. And segment number three. So with agreement for sale, it's always really important to show your experience and show proof that the project, like as we talked in section two, proof that at the end of the project, they're going to be able to get that property paid off and they're going to get the rest of their equity out. And it's important to show your experience through this process. If you haven't done this before, if that's something I could guide you with, or maybe another investor that's, done agreements for sale in the past. So to show your experience level, show that you've done real estate before. You have to give that seller some confidence and the seller's agent in a lot of cases, or sometimes the seller's uncle who might be doing showings for the property while they're out of the country. These are possible outcomes. Is you have to show all the components of your plan and show your credit worthiness or joint venture partner, right? You could be the operator, you could have a qualifier that's going to be getting a mortgage at the end of the term, that's going to go through CMHC process and get all that done. I would also suggest if it's a multifamily property that you get a great mortgage broker to do the underwriting on the property as is and then as complete or as stabilized once you've done your renovations, you've raised the rents, you've got all the releasing finished, all those elements are completed, then you can get that analysis from mortgage broker to say, look, if we do this and this and this, then the property value today is this, the property value in the future is going to be this, and we're easily going to be able to pay you out with the new financing. And that's the most typical exit strategy for multifamily is a refinance. And if it's smaller properties, fourplex or a townhouse or a house that you're going to renovate and put a basement suite in and then sell that on the market, then that's a little bit simpler, but then you need to be able to show the data and show the market comparables, show your renovation costs, especially if there's a little bit of, resistance or pushback on the strategy, the better job you can do of illustrating your plans, that your exit strategy is sound and you have a backup exit strategy as well, that seller's going to get paid on or before the end of the term. Ideally before the end of the term. And sometimes you can negotiate an extension. Let's say, for example, if the 1 year term is what the seller wants, you may negotiate an option in there in the contract that you can extend the contract for 6 months in case financing takes a bit longer, in case the leasing is a little bit slower, in case appraisal comes in a little bit lower and you might have to get another appraisal or work a little bit differently with the banks, or maybe switch to a different lender. Maybe you need a B lender to be able to refinance that property if it's residential, or go to alternative market lenders if it's commercial. So these are the kind of elements that you want to really describe to the seller or to the seller's team to be able to get the agreement for sale structure agreed and amicable and a win-win for both parties. Because really, you want to make sure that the seller wins, that they get what they need, you get what you need to make the profits that you and your partners are looking for. And it has to make sense to the seller, right? There's got to be a benefit for them. And one of the other last key benefits that I'll say is agreement for sale usually comes with a little bit of a price premium because you can pay a little bit extra for the property because you're saving all of that money in the down payment. Down payment ranges from 10% up to 15 and sometimes 20% if the asset is much larger. Maybe they have a ton of equity, versus a commercial mortgage. You have to put 25%, sometimes 30% down to make the debt service ratio work and make the numbers cash flow so the bank is happy. So the investor is saving a lot of money on the way in. Your cash on cash return goes up. So that's the benefit for the investor. You get flexibility, you don't have to qualify right away. You can buy limited properties with agreement for sale and never have to get a mortgage. So that's one of the key secrets about agreement for sale. So there's a lot of benefits for the investor, and there's certainly a lot of key benefits for the seller. Higher price, tax savings in a lot of cases. Those are the two key differentiators that benefit the seller. So your investor has got to benefit from the deal. Of course, the seller's got to benefit from the deal, and do consider that it's either cash or credit. This is the teeter totter, right? You pay cash, you get a better deal. You put it on credit, you got to pay interest. So in real estate agreement for sale, that interest is the price premium. So you're going to pay a little bit more. You're going to put a lower down payment in. Your IRR is going to be higher, and you have the flexibility of not having to get a mortgage out of the gate. Which, in the matter of speed to close the sale, put cash in the seller's pocket, that could be the quicker way to that while maintaining a higher value for the property. And if they've worked on that property for 2 decades or greater, that can be a major benefit to them. They know that you're going to, do a good job of the property and get them paid out within that period of time you agree on or before the end of the term for the agreement for sale. If you have any questions about these or would like to see examples of properties we've done in the past, areas we've done them in, ways we structured it, please reach out, give us a call, give us a text, contact us at the number below and the information that we can be reached there anytime. And if it's not about agreement for sale, we would be happy to help you with any of the real estate questions you may have. My name's Tim Reed, a real estate expert in the Calgary area. Look forward to seeing you in the next video.